Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Jason Hall and Matt Frankel giving a 1 to 10 rating to a company that's not a law firm or a bougie new clothing company. It's Walker Dunlop, ticker symbol WD. First, we'll rate the strength of Walker Dunlop's business, including factors like industry and competition. A 10 is invincible. A 1 is hopeless. Matt's at a 6. Jason's a little higher at a 7.
Yeah, this is absolutely my favorite company in race car tires and accessories for geriatric people. It's actually not in either of those businesses whatsoever. I rated the business a 7, and it would have been higher a few years ago. Its core business is tied to multifamily residential real estate lending and loan servicing, and that it's really critical in that business, but it's incredibly cyclical. Interest rates have gone up, transaction volume has crashed, and that's hitting the business. The servicing business is holding up well. Over the past 6 or 7 years, the company's made some moves to become a bit more diversified, but that's also made it more complex. That's also meant that resources have to be spread maybe away from other parts of the business. And because it's an ugly cycle in the real estate, and we haven't really seen how the results have paid off, and resource management is so critical, that's why it's a little bit lower score than I would have given it in kind of the healthy mid part of the cycle.
Yeah, I'm pretty much in agreement. I said a 6, and mainly because the market's so terrible right now in multifamily real estate. It's a very fragmented business. Walker Dunlop has roughly an 8% share of the multifamily lending market, and they're one of the top 2 or 3 every year. They compete with some pretty big players, like JP Morgan Chase is the number 1 in multifamily lending. So there's a lot of competition, and really the business is at the mercy of the real estate market. If 2021 happens again and money's free, this is a massive success. But if the market is in a lull like it is right now, they're really relying on the consistent parts of the business, like servicing, to keep them afloat. So it's really at the mercy of the real estate market.
For management, a 10 is Warren Buffett, a 1 is Homer Simpson. Matt's at a 9. Jason, you're the Grinch at an 8.
Yeah, directionally, we both obviously are big fans of management here. Willie Walker has a pretty long tenure with the business, and he's definitely been the growth catalyst over his past the 15 years or so he's been CEO. I'm also giving him a little bit of credit with that score, that some of those initiatives over the past 5 years are eventually going to deliver value. It's just harder to evaluate right now because of where we are in the lending cycle.
Yeah, completely agree. I said a 9. Willie Walker is one of my favorite CEOs in any industry. You ever see those "the most interesting man in the world" commercials? Whenever I have him on an interview, like I get that feeling that's who I'm talking to. Walker Dunlop was founded in the 1930s, so it wouldn't be practical to be founder led. But Willie Walker is the grandson of one of the original co-founders. He took over the business a little over 15 years ago. And until he took over, it was largely a pretty much like a boutique real estate finance firm. He really took it to the next level, led it through its IPO in 2010, and it's been a 10-bagger for investors since its IPO. So really great track record, and he's got a vision of what he wants the company to be. But like Jason said, it's just a terrible time in the cycle, and we can't really judge what these moves are going to mean until the market starts to normalize.
For financials, a 10 is a fortress, a 1 is yikes. Matt's at a 5. Jason, you're at a 7.
I want to try to be careful not to punish the company because of where we are in the phase of the lending cycle with commercial real estate, and think about it more of kind of across the midpoint of the cycle. How sustainable is the business, or is the financial profile built to sustain the downturns and then emerge when things get better? And I think the business is fine, which is why I gave it a 7. If you look at its leverage ratios and balance sheet, you might be worried. Matt's going to talk a little bit about some of the round numbers, but the balance sheet hasn't really deteriorated. This is kind of a cash turning business. So I think things are better than they appear, and they're probably about as bad as they could be considering where we are in the environment. So I think we're kind of in the bottom of the cycle from here, and they're just going to improve.
Yeah, I would agree. I said a 5. And like you said, I really don't want to punish the company just because of the current part of the cycle. But the reality is the numbers have been kind of ugly lately, in terms, especially when it comes to property sales and loan originations. Not really the company's fault. The service business helps keep revenue very steady in bad times. Walker & Dunlop pretty much services every loan that it makes, which is kind of unique. But it's not a lot of positive growth to report in the past couple of years. And I will say the round numbers. The company has about $180 million in cash and roughly 10 times that in debt, $1.8 billion, which looked a lot more attractive when the company had a $5 billion market cap than when it has a $2 billion market cap. But the company is still very profitable. So I do think we're toward the bottom of the cycle. And it's an opportunity, but the financials are still ugly.
I mean, it's essentially a bank. And those are reasonable leverage ratios for a bank, right, Matt?
Yeah, I wouldn't call it unreasonable leverage, but like I said, it's a high debt level for a company that they're not necessarily a bank, but for a company that loans money, it's not ridiculous. They get more from the money the loans they originate than they're paying on debt. So,
I think the risk, Matt, is bank-ish in that if things were to deteriorate really quickly, and I mean, it would have to be to the point where property owners would have massive vacancies and the company's in a situation where there's defaults on the properties, its ability to quickly monetize those properties to continue to maintain its debt, to service its debt, could get kind of shaky, right? So I think that's the thing that's the concern. But the reality, Anand, is if those things were to happen, we'd all have bigger concerns because multifamily real estate is one of the last parts of the real estate market where the people that stay in the properties can't keep paying.
Yeah, well, they do specialize in government guaranteed multifamily. It's worth pointing out.
Yeah,
they are the leader in HUD backed multifamily loans, and they're one of the tops in Fannie Mae and Freddie Mac multifamily loans. So that helps too.
Right. Now that I've clouded the waters with all that bankish talk, let's move on to valuation. How well will Walker and Dunlop stock do over the next 5 years? How safe is it? 10's a sure thing, 1's a lottery ticket.
I say 15% plus. And I mean, like Jason said, I think we're toward the bottom of the cycle. I did give it a low safety score because my projection assumes a lot of things. It assumes that the real estate market's going to relatively normalize. It assumes that interest rates are going to generally gravitate lower over the next few years. And it assumes that financing and property sales volume will recover to what I would consider a historically normal level, which it's not at right now. If all those happen, the stock will be a double or more in 5 years.
Yeah, I think that's right. The only place Matt and I differentiated is my safety score is a little bit higher. I think it's probably lower risk. The dividend offers a little bit of a margin of safety, with the caveat that if we do see further deterioration, the dividend is one of the first things to go away, right? To get cut if the companies start preserving resources. So it's not a perfect protective measure, but I think the risk reward profile is really, really attractive. The downside is if we just see where we are with transactional volumes doesn't improve, then the stock's not going to gain in value. It's just going to continue kind of moving along until there are catalysts that are going to drive that transaction volume up, which is really where the business starts generating substantial profits.
Let's move on to everyone's favorite topic. Matt, is there a company in Walker Dunlop space that you like better?
No, I own the stock, and if you're going to invest in any type of commercial real estate finance, it's really tough to make an argument against it.
I agree with Matt, and as so much to this is a stock that I bought back into my portfolio in some of the lows in April that I thought they were market lows, but Walker Dunlop stock has continued to come down, and the quality of the business is extraordinary. I think there's deep value here. Again, I wouldn't say this is like a perfect, buying the dividend right now, but that does to me kind of gird it a little bit and make it really compelling. And it's a fragmented industry too, and we've seen them continue to take share over the years. I think when the market does recover, they're probably going to expand their market share too.
Thank you to both Jason and to Matt. They've given Walker & Dunlop a solid overall score of 7.3 out of 10. That's a tick higher than the 7.0 it got last time. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is Confluent. Till then, Fool on.